Is it finally time to buy UK stocks and the British pound? Are we finally at a point where the vicious underperformance in UK assets is finally turning a corner? Have we reached the point of maximum pain at which markets are ready to start going the other way? That's the question we're going to be asking ourselves here. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And in the wake of the Fed monetary policy announcement that we've just seen, we find yet another monetary policy announcement, this time from the Bank of England. And here things look like they are likely to get interesting because, as with the ECB last week, there is an opportunity here for a bit of a rotation to break out. So first, we're going to take a look at what's expected. Then we're going to take a look at what the Bank of England might be looking at in its assessment of the economy to make its decisions this time and going forward. And then we're going to look at what is the tradable implication of all of this, how all of this is likely to move markets and where the trade might be. Let's start with a look at what is expected here. So looking at the priced-in expectations, we are looking at a mere 4.6% chance that the Bank of England raises rates this time. So the markets are all but certain that nothing is on the menu. We can see there that the peak in the odds of another hike in this cycle after a series of aggressive rate hikes over the course of last and this year that seemed to peak in August, we are looking at about a 36% chance cumulatively of another hike in February. So if we see that third column in from the left, the percent hike cut column, it's a 4.6% chance at this meeting. It's a 20% chance in December for a cumulative 25% at one of those two. So this plus this is that. And then another 10 or 11% chance that we're going to have something in February. These three together is the 36% chance that you're seeing right here. So, needless to say, what this comports to is the markets seeing a less than even chance that the Bank of England is going to raise rates again before it cuts them. Now, when are the cuts coming is, of course, the next logical question. In August, the likelihood of a cut is a non-negligible 63%. So the markets think that by this point, odds are better than even that we will have gotten a cut. We can see, looking at June, not a whole lot of cumulative likelihood, but about a 24% chance, then a 42% chance for August, and so a cumulative 60-odd percent that it's either June or August. But then, of course, by September, it's all the way priced in. So as we get here, the first cut is in. And right now, it looks like we're narrowly favoring August for when that occurs, 42, almost 43 versus 38%. But somewhere into the second half of next year, the easing begins. If we look at a slightly longer view of the curve, we can see that the way this has evolved has become more dovish over time. So the solid line here is the current implied policy curve, looking out 3 years. We can see that the larger dots here is when the BOE last met on the 21st of September. The little dots are where this curve was a week ago. And we can see that in both cases, the current curve, the solid line, is lower. It has shifted down, giving us a more dovish perspective on what the BOE may do. This is, of course, borne out by what's going on economically. So now, let's take a look at why policy is expected to do what it's looking like the markets are seeing in the UK, and why, at this point, it looks like rate hikes have really ended. The UK economy, much like the Eurozone economy, is shrinking. If we look at the past 3-4 months on this S&P Global UK PMI number, we can see that very tellingly we are below the 50 level now for 3 consecutive months, at least on the composite index. Now, of course, as with most of the world, manufacturing, the red line, has been in contraction territory for a year, well over a year. But services, again, as we've seen in most economies, had a nice pop at the start of this year. That pop has since fizzled, and what we are looking at now is 3 months below that 50 line. Now, the PMI indicator, as ever, works around that 50 level, where 50 is neutral, neither growth nor shrinking. Under 50 is contraction. Above 50 is expansion. The further you go above 50, the faster the growth. The further you go under 50, the faster the contraction. And so what we're seeing here is a situation where we're looking at a overall economy, looking at the composite line here, that's very much in contraction territory now for 3 months. So effectively, the equivalent of 1 quarter's worth of negative growth. So recession is very much knocking on UK's door. At the same time, inflation has been coming down. It's still relatively elevated. Needless to say, the headline number here, a touch under 7%. That compares very unfavorably with what's going on in the euro area, where we've now dipped into the low 3s or upper 2s, depending on whether you look at core or headline, and where we're in the low 4s or upper 3s in the US. Here, needless to say, things look higher. But the components of inflation really don't lend themselves to further central bank action. So we can see the biggest contributors to inflation here are food, housing, utilities and fuels, restaurants and hotels, recreation. Now, restaurants, hotels, and recreation, we can probably chalk up to the recession. That's probably something that deflates, so much as that spending is discretionary, and in economically difficult times, people tend to spend less on discretionary things. So there's a good story to tell here about the economy being so weak that over time, these things are going to see less demand. That will undermine their contribution to inflation. If there's less demand, there is less money chasing the same goods. Invariably, those goods go on discount to encourage more buying. And of course, that discount is going to translate to a smaller contribution from those things to inflation. That much seems to be on autopilot. For food, there's not really much that the central bank can do here. It's already coming in. It's been coming in for a few months. It's still by far the largest component to overall inflation. And here, not a whole lot of action for the central bank to take. It's other parts of the inflation story that the central bank needs to work out, because there's not really a whole lot that the central bank is going to do on interest rates to discourage people from eating. So if the price of food is essentially a given because everybody does need to eat, well, then this is not really a policy consideration. This brings us to housing, utilities, and fuels. Now, as with the U.S., there's a bit of locked-in inflation into the housing market, but because fixed-rate mortgages are not nearly as common in the U.K. as they are in the U.S., there's a bit more room for housing to adjust. That's good news for the Bank of England. And for fuels, as we saw in spades in the euro area, we're likely to see further base effect reduction in inflation because the spike from energy costs last year is getting worked out of year-on-year calculations. So at this point, we're getting to a place where that is going to shrink as a contribution. So as long as everything else seems to be working, it looks like inflation is on a path to really work its way down. And indeed, what we're seeing in looking at UK labor markets is quite encouraging. At this point, we see that whereas at about this time, maybe a little bit more than a year ago, in 2022, there was still a very significant shortage of labor. We can see now that shortage is briskly being worked away. So this right here, that's UK labor supply minus demand. So we can see as we get the breakout of COVID, obviously we get lockdowns. And so there's a huge jump in the supply of available labor relative to demand because everything is closed. There is no demand. Not much to speak of anyway. So there's all this labor, but no jobs. As we start to come out of COVID and the jobs return, we start to see more and more of a shortage develop, and this surplus is worked down to next to nothing and even dips into deficit a little bit by August of 2022. Since then, we can see tightening has helped to drive this back up. This, of course, is the recession or the near recession now underway in the UK doing its work. And of course, inflation has started to edge lower in tandem. This is the core inflation number, not the headline. The headline we saw is 6.7, the core 6.1, a little bit lower. And that's after you factor out energy and food. And as we just said, food is the biggest component to headline inflation at the moment. And energy is on a path to diminishing. So what we're looking at here is that sticky part of inflation, the part that doesn't easily adjust lower with weaker economic conditions because wages tend to get locked in contractually, and it's not easy to lower wage levels and labor costs to business without layoffs. And so what we see here in the rise of labor supply relative to demand, as that surplus rebuilds, we are watching those layoffs have an effect. We are watching the recession have an effect. And so it would seem that even that sticky part of the inflation puzzle that central banks have been so worried about, really everyone. We just heard about it from the Fed mere hours ago. That seems to be on the path toward mending, at least in inflationary terms. Now, obviously, it's not good news for anyone losing their jobs, needless to say. But from the central bank's perspective, this is the thing that you want to see if you want to squeeze sticky inflation out of the market and out of the economy, of course. In fact, if we look at UK financial conditions, we can see that they remain significantly restrictive. So here is COVID. Obviously, that came with a tremendous amount of stimulus initially, and we can see that this was still something that was supportive. But at this point, we're back to tight financial conditions. And so what we're looking at here is already a situation where things look a bit like the Bank of England can take their foot off the gas. Because at this stage, financial conditions are still restrictive. They're doing their job at deflating those parts of the economy that need it, or where the central bank actually has agency. And so the Bank of England can step back and say, okay, we're going to let the recession do its job. Which brings us to, how does one trade this? What is one here to do? How does one take advantage of what's going on? So let's take a look at what the implications are for those of us looking for a trade idea in all of this. Well, we bring back a familiar story, and this should look very much like that UK PMI story, and for good reason. It's because it is very much like the UK PMI story. It's the story everywhere. So let's take a look back here. We can see a pointed decline through 2021 into 2022. At the start of 2023, an uplift in services that takes up the composite with it as manufacturing remains anemic. That crests going into the second half of the year toward the end of the first half. And here we are. If we look at the global averages, it's much the same thing. A pointed decline through most of 2021 and 2022, a pop in services leading the overall economy higher. That peters out going into the middle of the year. We are now just a hair above that 50 boom bust level. This is as of September. We're going to get October numbers on the global reading actually tonight. And at the moment, it looks like, having seen the input numbers, having seen the regional numbers come out over the past several weeks, it should not be surprising that these numbers are going to remain anemic. So if everybody is going into a recession, or at least are flirting with recession at the same time, then conditions are relatively negative. This might explain, of course, why central banks are backing away from rate hikes from one to the other to the next. We've heard it from the ECB last week. We heard confirmation from the Fed today. We've heard similar sentiments from a whole range of major central banks. Bank of Canada was certainly there. RBA is still a bit coy, but nevertheless is starting to look like it's aiming in the same direction, on and on and on. And so looking at all of that suggests the economic conditions that the world is facing are not so great. But that isn't what moves markets. What moves markets is the difference between reality and expectations. Needless to say, nobody can know the future until it occurs. But markets have to invest with the future in mind. They have to be forward-looking, because what moves the price of an asset isn't clearly what's already priced into that asset. Because, of course, it is priced in. So by then, all movement from whatever change in conditions occurs has to come from what is being priced in being no longer valid, and for there to be a need for readjustment. To get to that readjustment, reality has to somehow clash with baseline expectations, which is precisely what we see here. From about the middle of this year, there has been an improvement in global economic data performance in relative terms, relative to forecasts. Now, does that mean the situation is not dire? Of course not. Does that mean that the world isn't flirting with recession? Of course not. But what it means is that investors' expectations baked into asset prices have been worse than the realized outcomes. So while the outcomes have been bad and weak and pointing toward economic stagnation, what they haven't been is worse than expected. In fact, they've been increasingly better than expected. And much of that is, of course, the expectations themselves are so downbeat. So, with that in mind, we are looking at a situation where perhaps markets might look and say, okay, if the situation isn't getting worse, then perhaps there are bargains to be had now that we see that the situation probably has reached a point of maximum pain. That is, it's maybe not going to get very much worse here in the near term. At least, one might argue, not for European assets. And this is where the bargain hunting becomes most interesting. We see that U.S. markets, which have been much stronger economically, they've had a much more resilient economy as their foundation, they understandably outperformed this year. Whereas assets in the UK, assets in the Eurozone, even emerging market assets, they have been aggressively downbeat. They are down on the year. In fact, if we look at the collective performance gap between the regional tracking ETFs, in this case, SPY is for the US, EWU is for the UK, we can see UK is down almost 4% this year. US is up a meaningful amount. At this point, almost 8%. That's a bit of a climb down from the 15 or so percent in the turn of the year, but nevertheless, still a meaningful increase. So the gap here is close to 10, 11%. Now, if the Bank of England is in fact ready to say we are done raising rates, but everybody is going to some kind of an economic downturn, then the relative value might well be had in markets that have been underperforming, because the focus stops being where are rates going to be higher, if everybody's going to stop here. It's where is the stimulus going to come soonest to give the most tailwind to risky assets. And listening to the Fed earlier today, as expected, we get a reluctance to even think about rate cuts. So if the Bank of England comes out today and says, in stronger language than the Fed, much like the ECB, we're vigilant, we're looking at inflation risks, we're prepared to act if necessary, but we're probably done. The economic situation is dire. We think that inflation is now on a path to decline because of the cumulative actions that have already been taken. Well, then stimulus might well be faster coming in the UK, much as it is in the Eurozone. Tellingly, when nearly the identical message came out of the ECB last week, the euro not only didn't fall, it rallied. Now, typically a currency doesn't rally when a central bank is dovish. Why? Because, of course, that undermines the appeal of the currency in terms of relative yield compared to others. So one would think that a Fed that isn't rushing to hike again, but is nevertheless not rushing to cut, still maintains a healthy yield advantage against those central banks that are looking to cut. But if the markets are convinced that everybody has stopped, but the situation is not as bad as feared, then the first conclusion one comes to is that the markets are going to be on the lookout for risk and not safety. It'd be different if the situation were worse than expected, but that doesn't seem to be the case, looking at what we're seeing here. And so with that in mind, risk on. Now, risk on where? Well, in Europe, we are likely to have more support for risk sooner, it looks like, than in the US. We heard that from the ECB last week. And if we hear the same from the UK today, well, then it might very well be the magnet to tell capital to say, we're down nearly 4% on UK stocks. That's a bargain. If everybody is going to start cutting and the tightening cycles are truly over everywhere, where does one go? ostensibly to where there is the greatest space for increase. And in the US, we've already been outperforming all year. So perhaps the place to be is the cheapest. And that, or at least in relative terms, of course. And in that sense, the UK looks attractive. But what is the subtext? Well, if you're going to go buy UK assets, then you need British pounds. And so not only might you get a increase in UK stocks as a consequence of this, and EWU is the ETF that tracks that, we are likewise likely to get a rise in the British pound, even as the central bank is more dovish. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, where we discuss what happened on Wall Street and generally in markets on a given day and try to figure out what it all means and where we're going next from there. I'm also on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Good luck out there. See you tomorrow.